I'm very glad to be able to talk to this particular audience, and I want to do my best to make sure I leave time for question and discussion because I can use your help. Because I am telling a story that is very difficult for people to hear. And it's difficult for people to hear because you can boil the story down to we've all been making a terrible mistake for 20 years and we need to recognize we've made a mistake. And that's not something people listen to very comfortably. So let me tell you how the story goes. The first part is understanding what we've all been taught for the past 20 or 30 years. And it's what I was taught. When I went to law school and when I took economics classes for my master's, I was repeatedly told that shareholders own corporations, that corporations are well run when directors maximize shareholder value, that this was best for society because shareholders were the residual claimants in the firm, and therefore if you maximized the value of the shareholders' residual, that meant you were maximizing the value of the firm. And I was also even taught that the best way to measure the value of the firm to shareholders was always to focus on share price, because this was back in the days when so-called efficient market theory really dominated the economics world. And I completely internalized what I was taught. Except the problem was I then went on to become a corporate law professor myself. And that meant I had to read real corporate law cases. And I also joined the board of directors of a mutual fund, which meant that I got to see how people really behaved in business and in the boardroom. And it became apparent to me that what I had been taught did not describe the world that I was seeing. It didn't describe the actual law that I was reading in the cases, and it didn't describe the actual corporate behavior that I was observing in the boardroom. And I began doing some theoretical work on alternatives to the classic so-called shareholder primacy view. But I did a little bit of work, and some people liked it, and a lot of people thought I was crazy, and I was working on other projects, and I didn't focus too much on it until I, along with everyone else in this room, experienced the last 10 years. And I, along with, I suspect, most of the people in this room, began to suspect that our corporations were not doing the kind of job for our society, for their employees, for their customers, and most of all for their investors that we wanted them to do. And I began to suspect that this mythology that I had been taught was actually impeding the ability. The more it was embraced by the business world, the more it was taught, the more everyone took it for granted, and the more managers actually ran firms to try and maximize share price, the worse the results seemed to be. And so that was the motivation for my writing this book, The Shareholder Value Myth. Here, I'll wave it around because I happen to bring a couple of copies, one for Mike and one for Mark. But I wrote this book. And actually, the origin of the book is really interesting, too. I wrote this book because the publisher called me up and said, I want you to write a book. I've read some of the stuff you've written in academic land, and I want you to write a book that people who are not legal scholars can understand, because I happen to run a corporation. And I am really concerned about what I see. And I think that we need to have an explanation of this that's accessible, that's available to people. And he was absolutely right. I'm so glad that I wrote the book that he decided I should write. So what does it say? Well, what it says is, and this is the hard part. So we have this cherished myth that shareholders own companies and that companies are run well when managers focus on maximizing share price. Some people even subscribe to the myth that that's what the law requires. Actually, a lot of people, especially journalists, subscribe to it. So it turns out, I argue in the book, that if you look at that myth, it's not correct. And it's not correct in at least 3 distinct senses. First of all, let's start with the legal stuff. There is no legal requirement that the directors of corporations try to maximize profits or share price. And when you ask people for evidence that there is, they cite the same darn case over and over, Dodge versus Ford. Now, here's the problem. This case is almost 100 years old. It comes from a state that is very unimportant in corporate law, Michigan. The state that really matters is Delaware, and Delaware has never cited Dodge versus Ford for the proposition that there's a duty to maximize profits and share price. It also is actually not a case about public corporations at all. It's actually a case about a closely held company where there was a fight going on between the controlling majority shareholder and the minority shareholder. But the most important thing is that the part of Dodge versus Ford that everybody cites is a statement that lawyers call dicta, meaning it's just an offhand remark that was not necessary for the court to reach the result it did. And even this offhand remark, here it is. Here's the primary evidence, Exhibit A, for this mistaken idea. A single sentence in Dodge versus Ford which says that corporations are run primarily for the profit of the shareholders. It's not even entirely, it's primarily. So when you look at the state that really counts, and when you look in the 21st century, what you find is actually cases like Air Products versus Air Gas, where the Delaware Chancellor says, and I quote, "There is no per se duty to maximize shareholder value in the short run." The court doesn't say whether there's a duty to maximize it in the long run or not, but since corporations live potentially forever, the long run never arrives. And what the court did in that case was, it was a company where the stock was trading at $40 or $50 a share. Somebody showed up, wanted to buy the company at $70 a share. The directors said, "We don't want to sell, and we don't care if our shareholders are missing an opportunity to make a $20, $30 profit." And the Delaware court said, "That's fine, it's up to the directors." So what the case illustrates is there's this thing called the business judgment rule. And under the business judgment rule, it turns out actually there is no legal requirement for directors to do anything, pursue any particular corporate purpose. What they have to do is, one, they can't steal from the firm. That violates the duty of loyalty. They have to be disinterested. And number two, obviously the firm has to be profitable enough it survives, otherwise the directors lose their job. But those are really the only two constraints. One, a legal constraint, they can't steal from the firm. One, a practical constraint, the firm has to at least survive. Beyond that, though, there's this huge legal vacuum. It's an open space. You can run a C corporation for any purpose you want, as long as legally the directors don't steal, and as a practical matter, you make enough money to survive. So the fact that there's this huge legal vacuum doesn't mean, of course, we can't fill it with something. And when you push most legal experts, they will concede there's no legal obligation to maximize shareholder profits. But what they then say is that's still the best way to run a company. And here they use a suite of claims about the economic structure of corporations that also turn out to be incorrect, and that actually, I think, originated with economists. And why the legal people got fooled into citing the economists on the legal structure of firms is beyond me. But the first claim is that shareholders own corporations. Here's the problem. As a legal matter, that's not true. Corporations are legal entities. They are legal persons, as the Supreme Court correctly reminded us in Citizens United. What that means is they own themselves. Non-lawyers have a hard time getting their heads around the idea that you can have a legal entity that owns itself, but that's what the law says. Meaning that the money of the corporation and the profits earned by the corporation belong to the corporate entity. What do shareholders own? Well, guess what? They own shares. And what shares are is a contract between the shareholder and the corporation, just like the contract that a debt holder owns when they buy a bond, just like the contract that a human being enters when they enter an employment contract. Okay, so then we get to the next claim that's often made, which is that shareholders are the principals and directors are their agents. I'm not going to belabor this because it's the kind of thing that only legal experts can get really excited about. But I'll just say that legally that's completely incorrect, because one of the hallmarks of an agency relationship is that the principal gets to control what the agent does. And corporate law is very clear. Shareholders cannot tell the directors how to run the firm. What they can do is refuse to re-elect those particular directors. And this is a real power in private companies with a controlling shareholder. But as a practical matter, in a public company where you've got hundreds of thousands of shareholders, that virtually never happens. The directors, as a practical matter, elect themselves, except in the most extreme cases. So the principal agent argument doesn't work. Then we get to the residual claimant argument. And that one really doesn't work, because shareholders, by the way, how many of you have heard this residual claimant argument? I don't know what level of detail you might have gone into this. Has anybody ever heard this argument? Oh, heck, I'm going to skip right over it. It's wrong. Then we'll get to stuff that I think you do understand. which is that all of the evidence suggests that this strategy isn't working. So what's happened over the past 15, 20 years is not only everyone's been taught that corporations should maximize share value, but we've changed the law and we've changed business practice to move in that direction. So we see Congress amends the tax code to require executive pay to be tied to an objective metric. What's the metric everyone picks? Stock price. You would think this would produce a huge increase in performance, wouldn't you? If the problem is those lazy executives not doing a good enough job for shareholders, tying executive pay to share price should fix the problem, right? Maybe not so much. We see a bunch of changes at the Securities Exchange Commission that are designed to give shareholders more power over boards, make it easier for them to cooperate with each other to vote, maybe even give them access to corporate funds to try and mount proxy contests to throw out directors that don't do the shareholders' bidding. And what we certainly see is the embrace in the boardroom and in the executive suite of this normative ideology that we've been taught, that what the job of the managers is to maximize share price, preferably in the short term. How has that worked out? Let me say that shareholder primacy theory predicts that the more we run firms this way, the better we should get. We should see more corporations. We should see our corporations becoming more profitable. We should see investors getting higher returns. And we should see people flocking to the United States to form US corporations because that's the way to create a successful company. We are seeing exactly the opposite. This is what we are seeing. First of all, we've had the first 30-year period in history where corporate bonds have outperformed corporate equities. First time ever. And that's in part because the last 15 years, it used to be we referred to the lost decade of shareholder returns. We're now working on the lost decade and a half. Meanwhile, our public companies are literally disappearing. The population of public companies was, where are my notes? It was like 8,800 and something. In 1997, the number of publicly listed companies in the United States now is down to around 5,400, a 40% decline. If this were a species, we'd call it endangered. It's purely anecdotal, but we also have a collective sense that our corporations are not performing as well for society. Maybe it was the abrupt collapse and near extinction of a bunch of financial firms that triggered a massive credit freeze that has thrown our economy into a deep recession that leads to that impression. We could also mention a few things like Enron, which was a model of good corporate governance in which both executive and director pay was tied to stock price. You know, if this is the best model, Enron should be our big success story. We see things like BP. BP is a company that was famous for focusing on share price, and that was a really great strategy in the short term. Has not turned out so well. You know, BP is now frantically selling off every asset it can get its hands on to try and pay off its bills from the Gulf oil spill. Okay, so when we look at the macro data, the more we seem to embrace this idea, the worse results we get. And the second, that's the first part of the book. It's trying to, and the communications people, help me out here. I'm trying to motivate people to be willing to consider the possibility that they might have been mistaken about this. And so my crude strategy is one possible motivation is the fear that things will get even worse. So if I can focus people on how we're not getting good results, that might motivate them to consider changing their minds. Then we get to the second part of the book, where I say, I've got an explanation for why focusing on share price is producing negative consequences. And the explanation goes something like this. We need to remember that this whole idea that corporations are run well when they are run to maximize share price is something relatively new on the business scene. It actually only really starts appearing in the mid-1970s, early 1980s. For most of the 20th century, the philosophy that dominated the business world was something called managerialism. And under managerialism, directors and executives did not view themselves as agents of shareholders who are out to maximize shareholder wealth. They viewed themselves as stewards or trustees of great social and economic institutions, public corporations, and they thought that they had a trust, a public trust, and that what they should do with their corporate positions was to run the firm so it would be of benefit not only to investors, who, by the way, got higher returns under this system than they're getting today, but also for the benefit of employees, customers, and the nation as a whole. So where did that philosophy go? And that philosophy, by the way, was generated from within the business world. But it begins to break down in 1973 and 1974 because we experienced the worst bear market since the Great Depression. Now, if any of you are as old as I am, you may remember, why did we have the worst bear market? Well, it might have had something to do with the fact that there was an oil embargo and the price of oil quadrupled in a matter of months. Just imagine what would happen to our stock market today if the price of oil went from $100 a barrel to $400 a barrel. But because we had this bear market, I think that opened up managerialism. It made it vulnerable to criticism. And where the criticism came from was from the ivory tower, and especially from a famous article by William Meckling at Rochester and Mike Jensen, who was then, I think, at Rochester, but subsequently went to Harvard Business School. They wrote an article. It's the most frequently cited article in the managerial literature. It is the #1 article. And in their article, they said the problem with our corporations is that we're not running them enough in the interests of the shareholders. And we've got these wayward managers who aren't focusing enough on shareholder value. That's why you're getting a rotten return on your investment. Never mind anything about oil quadrupling in value. Apparently that was not relevant. It was all because of the problems with the corporate system. Never mind, we'd had that system for over 80 years, and it had actually been working pretty well for most of those 80 years. I mean, 1929 was a problem, but we got that straightened out with the securities laws, and it was pretty solid after that. So really, this idea you have to understand is an example of top-down central planning by academics. It's not something, and I love being able to do this because many of the people who embrace this idea are sort of Chicago school economists, and I get to use Hayek against them for those of you who follow philosophy. But Hayek was a Chicago school free market economist, and he was the one who hated central planning. So this whole idea of maximizing shareholder value is an example of academic attempts at central planning, sadly very successful. So we've got this situation, we've got this idea, it came out of the ivory tower, we've now been test driving it for 20 years, it's not producing good results. Why not? I think the reason is because it makes the following mistake, and this is a natural human mistake. Again, you communications people will get this. People tend to think of corporations as fictions. Why? They're invisible, and we're a visual species. You can't touch them, we're a tactile species. They can only speak through human beings. Therefore, for most people, it's very hard to understand that the corporation is an independent legal entity. On the other hand, where we think, many of us, that corporations are fictions, they're not, they're very real. We tend to think of shareholders as real, and they're not, they're fictions. The reason why we think of shareholders as real is that when we say that word shareholder, what's the image that pops up in our mind? A human being. And that obscures our ability to recognize that when we talk about maximizing shareholder, we're assuming there's some platonic entity out there that cares only about the price of a particular stock tomorrow. No such platonic entity exists. What we have are real human beings who own shares, but they own lots of other things as well, including their own human capital. And these human beings are going to be holding those shares for different time periods. Some are going to be holding them for a few days or a few months. Some of them are going to be holding them for 20, 30 years while they save for retirement. And these human beings have different views about how willing they are to harm other people and to violate ethical rules in the law in order to get a material return. And by the way, I've got another book called Cultivating Conscience, How Good Laws Make Good People, that sort of studies this phenomenon of people being willing to make sacrifices to avoid harming third parties and to avoid violating ethical and legal rules. You want to hear the good news? That just describes 97% of us. What do we call the other 3%? I hear it. Psychopaths or sociopaths. Yeah. But the fact is, the data demonstrates that the vast majority of people, now that doesn't mean we're Mother Teresa. We're not going to give away everything. But if you can avoid harming someone by making a modest personal sacrifice, 97% of us will. So that's the good news. We're a nicer species than we think. Yeah?
How much of that 3% is in the institutions of power right now?
Well, I've seen some nasty estimates about banking executives. Although even then, I haven't seen an estimate higher than 50%. My own estimate was probably more like 10%. But anyway, so when we talk about maximizing share price, what we're actually doing is we're saying we have a range of human beings that have different time frames. Some are more or less diversified, and some are more or less pro-social or asocial meaning sociopathic. If we go out and run our corporations as if the job of the managers is to maximize share price in the short term, what we're doing is saying out of that human mix of people who own shares, we're going to be privileging the very small subset who are most short term, who are least concerned about external costs, and who are most sociopathic. Now that's kind of as far as the book gets, but I hope that people can understand that my point is, and why are we doing this? Even if you think that corporations should be run only for shareholders, why should we define their interests so narrowly that we're privileging the shareholder who only cares about tomorrow's price, doesn't care if maximizing tomorrow's price damages the environment, damages their other investments, damages their human capital? I see this incredible irony. I see pension funds that are pushing corporations to reduce expenses by firing employees. And by the way, who is the pension fund supposed to be representing? Right? Why should we privilege the investor who wants corporations to violate the law, violate ethical rules, and harm third parties, when the data suggests that 97% of us don't fit that description? So here's an alternative. And I don't put this in the book, but I might. And then I'm going to stop talking because I'd love to get questions from you. Why don't we say, if we're going to pick and choose among this heterogeneous subset of investors, couldn't we just as easily say, no, we want to focus on representing the interests of the investors who are holding for the longest possible term. We want to represent the interests of the investors who recognize they have diversified investments, who don't want the company to maximize share price by harming other companies, harming other industries, harming, firing employees, and damaging the environment so that they're breathing unhealthy air and drinking unclean water. And we want to represent the interests of the employees who have a conscience and would be completely willing to sacrifice a few little percentage points, a few basis points of profits, if this will allow the firm to be run in a more sustainable, ethical, environmentally responsible fashion. And if you focus on the interests of those shareholders, how interesting. Aren't you also then defining shareholder value in a way that makes corporations perform better not only for investors, but for everyone else as well? So I think that's probably enough to get you started. And so at this point, I'm happy to open it up to questions. Yeah.
How do you see this alternative as being different than the current socially responsible investment model?
Great question. Okay, so traditionally in corporate law and in corporate policy, there have been three schools of thought. School of thought one, far and away the dominant one, is the shareholder primacy school that I've described. But it's always had some pretty feisty competition from a minority of scholars who adopt what's called a stakeholder view. And I think, by the way, the stakeholder people clearly have got the intellectual high ground on this, because what stakeholder theorists point out is that shareholders are not the only residual claimants in firms. I guess I'm going to have to do the residual claimant theory after all, aren't I? I'll do it quickly. So the residual claimant theory, the residual claimant justification for shareholder primacy goes like this. Employees, customers, the government that gets paid taxes, each of these people get benefits from corporations, but their benefits are determined by law and they're fixed. You get your salary the corporation agreed to pay, you get your interest payments the corporation agreed to pay, you get the taxes that the law requires you to pay. Every other penny of profit should go to the shareholders. Therefore, since all of the other so-called stakeholders' claims are fixed, if you can raise the value of the shareholders' interest, that proves you've raised the value of the firm as a whole. The problem is that's legally incorrect. Shareholders don't get every penny. The corporation gets every penny, and guess who decides what stakeholder gets what share? The board of directors does. So if the company has a very profitable year, the board of directors could pay that money out as a dividend, but they could also look to the employees and say, we're giving you a raise. And they could make charitable contributions. And they could say, we're going to keep a big chunk of money, we're going to indulge in research and development that's going to develop great products that are going to benefit consumers in future generations. So it turns out it's factually just wrong to say that shareholders are the sole residual claimant. And once you recognize that, this is where the stakeholder theorists come in. They say, well then shouldn't we be saying that what we want firms to do is maximize all the benefits they provide to everyone who's in the firm, all the stakeholders? So if we're judging if a corporation is doing a good job, don't just look at the dividends and the share price. Look at the wages it's paying. Look at the products it's selling. Look at the taxes it's paying. So there was a small feisty group. But even that stakeholder theory doesn't address the problem of corporations imposing harms on third parties who aren't stakeholders. So you could run Royal Dutch Shell or some petroleum company in a fashion that's stakeholder conscious and still having them going to Nigeria and hiring private armed guards that are burning down villages. And you would say, hey, the villagers aren't stakeholders. We have no relationship with them. And that's where corporate social responsibility comes in. So I think of it as, you can almost think of it as three widening rings of theories of social responsibility. The narrowest is the shareholder primacy. Stakeholder theory broadens that out a little bit. The broadest is corporate social responsibility. All I'm trying to do in this book is move the ball past narrow shareholder primacy. But if I can even get people to concede that it might be better to focus on the interests of the shareholder who is long-term diversified and pro-social, you're going to get a lot of corporate results that are better for stakeholders and better for third parties in society. So did that answer your question? Yeah, okay. Try. Yeah.
Comment.
Yeah.
With today's sad unemployment situation,
yes.
I would think that it would be easier to get more buy-in for this because there's so much distrust with people that are holding stocks and
yeah. I think that's absolutely right. And it's one of the reasons why I agreed to write the book. I would never have wasted my time writing this book 10 years ago because no one would read it. But today, I think people are willing to consider the possibility that we've been making a mistake because we're now living with the consequences of the mistake. And I mean, think of the irony. What you've got are these corporations that in order to meet short-term share price demands are firing employees. What happens? The employees don't have disposable income. They stop spending. The consumer base begins to disappear, affecting not only that corporation, but all other corporations. In effect, by refusing to hire and to pay decent wages, our corporations are cannibalizing their own consumers. And it's driven by these short-term pressures. Okay, yeah. In the back? Yeah.
So just to play devil's advocate
Yeah.
for a moment.
Please do. Please do.
If I'm a corporate CEO in
Yeah.
today's environment,
Yeah.
what motivation do I have to carry out any policy other than short-term maximization of profit? Considering 5-10 years now I'm going to get my golden parachute
Right.
anyway. Why would I listen to you,
Right.
when it means less profit for me when I retire?
Right. And my fear is you will give lip service to corporate social responsibility and to taking care of your stakeholders while still doing exactly the things that we know can bump up share price temporarily at the expense of long-term results. Those include massive dividend payments, massive share repurchases, cutting cuttable expenses like R&D and employees, and selling off parts or even the entire firm. So you've put your finger on, I think, one of the biggest obstacles we face, which is the mistake that Congress made in 1993 when it amended the tax code to require boards to tie executive pay to an objective performance metric. And one of the ironies of that is that it was driven by this sense that directors could not be trusted to set fair compensation, And again, it's that top-down central planning idea that academics and reformers and bureaucrats, whose pay, by the way, isn't tied to anything, right? But they thought they knew better how to incent executives, and they put it into law. And what that actually did is, to some extent, it did take control away from directors, because what they could control was the ex-ante metrics. But what they couldn't control was the executive's ability to go out and manipulate those metrics and come up with results that were good on paper, but actually disastrous for the firm. And then you accompany that with the steady decline in CEO tenure to the point where now the average CEO is in his or her job for 5 years. You get exactly the dynamic you've described. You've got someone who says, okay, I've got shares, they're going to vest in 3 years, I'm probably going to be gone 2 years over that. You know, yeah, I can think for the very long-term future, which is, by the way, what corporations were designed to do. Hopefully I'll have a chance to come back and do that. Or I, as an individual, can maximize my own personal payout. And this is where we come back to that Mother Teresa thing. I actually think most CEOs are not sociopaths. But even non-sociopathic people will not make huge sacrifices to avoid harming others. And when you've got someone and you know, asking an executive to turn down the opportunity to walk away with $100 million is asking too much. Yeah. Okay, you want to follow up briefly?
Just quickly. So, and in as much as there seems to be a new mentality, like we can't have like too big to fail, means we
right.
need to
right.
bail out these companies,
yeah.
trying to get after their CEOs,
yeah.
flood the coop and they go under.
Yeah.
There seems to be even less of an incentive then for corporate CEOs and like boards of directors to have long-term policies, and they just get bailed out for every mistake they made along the way.
Right. Or at least that's a specific problem. There certainly is an incentive for them to take on huge amounts of risk on the theory that heads I win, tails the taxpayer loses. Yeah. Okay. Yeah. Another.
I'm just curious, given that we have now a range of socially responsible investment.
Yes. Yep. Yep.
And so if people, and they generally are looking to make a good economic return, but not to have the negative
right.
consequences you want.
Yeah.
And yet, while they've grown, they represent a small fraction of places where people choose to put
yeah.
their money. So
yeah.
if 97% really prefer that.
Why aren't 97% of us putting our, oh, I'm so glad you asked this question. Okay, so I wrote this book called Cultivating Conscience, and what I did in it, there's really very little that's original in the book, at least in terms of the social science. But what I tried to do was summarize 5 years of personal research I'd done, reading every darn article I could read in behavioral life and sciences and in psychology on when people are pro-social. Translation in layman's terms, not jerks. And what I found is that we have this 3% who are always going to do whatever makes them better off, to hell with anybody else. We call them sociopaths or psychopaths. Then we have the other 97%. But that doesn't mean the 97% is always pro-social. We're actually subject to something I now call the Jekyll Hyde syndrome. What we see is that people routinely shift from purely selfish modes of behavior to more other regarding pro-social modes of behavior, and we don't even know we're making the shift. So you behave very differently when you're buying a used car than you do at a wedding reception, right? Completely different mode of behavior. So different it shows up on PET scans. You use different parts of the brain, different areas of the brain light up when people are making purely selfish decisions from when they're making decisions that take account of others. But what's really interesting to me is that which brain system you're using seems to depend a lot on what we will call social context, social signals. What are the big social signals? Have you been told to be not a jerk by an authority that you recognize as part of your in-group? Do you think that other people aren't being jerks? And do you believe that not being a jerk will actually benefit other people who are in your in-group? By the way, and for most people in the United States today, our definition of in-group is really, really broad and includes chihuahuas and favorite laptops and things. So humans are really, really plastic. I mean, a lot of people tend to think that we're innately tribal, and certainly we are prone to that, but the flip side is that we're also capable of having very broad views of whose welfare we should take account of. So here's the problem with the investing social context. The way it's structured today makes people act like Mr. Hyde instead of Dr. Jekyll. We're told that it's totally appropriate to be selfish when you make investing decisions. We think that everybody else is being selfish when they make investing decisions. And we're told that that will produce the most efficient result, because that's the theory of shareholder primacy. We're actually told that we benefit society by being selfish. I would love to see, oh, you would be good folks to do this. I would love to harness that power of our innate human decency in investing by trying to change the investing context. I would love to see someone doing an advertising campaign. You know, you wouldn't throw litter out of the window of your car. You wouldn't dump your garbage in your neighbor's backyard. Why would you invest in a socially irresponsible fashion? That would be really, so anyway, so thank you for bringing it up. By the way, the amount of professionally managed assets that are in socially responsible funds is now up to 13% in the United States and 17% in Canada. So, and it's heading upwards. But I think we could get a lot more if someone, you know, maybe some of these religious groups were willing to basically put together a media advertising campaign that raises people's awareness that when they make purely selfish investing decisions, they could possibly be harming others and breaking ethical rules. Yep. Yeah. Yeah.
I was just going to make a comment about awareness, because if I were to ask my parents how do you feel about investing, of course they would respond exactly as you described. Oh, we'd like to, you know,
Right.
invest in
Right.
the proper way, so to speak. But they're also, I think, so trained to listen to that authority figure that I don't know that they would take that much ownership. I think that they listen to whoever's managing their accounts and they trust without support or evidence that maybe they're doing the right thing.
Yeah.
So I think that's
Yeah. But you could influence their decision what kind of professional money manager they should trust. And that's where the advertising campaign would come in. So a really exciting development that we're now seeing that I think is even more potential. What socially responsible funds do traditionally is they have screening programs where they try and avoid unethical investments. So avoid tobacco, avoid weapons manufacturers, sort of the traditional sin industries. What we're starting to see now, though, is something I find much more exciting: social impact funds. That rather than trying to avoid the bad things, actually focuses on good things. So you could imagine a fund that focuses on investing in green technology, or a fund that focuses on investing in pharmaceuticals that will cure massive, third world diseases, AIDS, HIV, malaria, whatever it might be, or a fund that focuses on preserving the ecosystems and the habitat of what they call charismatic megafauna, the lions and tigers and things. And I think because those sorts of funds have the potential to tap into the passion of people who feel uniquely strongly about each of those issues, I think, again, if I had any entrepreneurial instinct at all, and I have to tell you I don't, I get passionate about ideas. Honestly, money kind of bores me as long as I have enough to pay for my house and my car. But if I did care about money, I would be looking into developing social impact funds. Too bad we don't have any business school students here. Yeah, you all look bored by it too. But believe me, if I were giving this lecture at a business school, they'd all be taking notes right now. Okay. Yes?
Do you think if there was no CSR, corporations would be philanthropy?
If there were no CSR, would they do philanthropy? Actually, I think the answer is yes. And I say that because if you look at the history of corporations, before shareholder primacy became such a dominant philosophy, they did a lot of philanthropy. If you look at corporations that were run under the old managerialist philosophy, they did a lot of things to contribute to their local, it was sort of understood you would contribute to your local community, you would contribute to the nation state. Now, I'm not saying, again, that the corporation behaved like Mother Teresa. But I think they did give money, and I don't think I think one of the problems with shareholder primacy is that it's driven a very cynical view of corporate philanthropy, where executives feel they have to justify it by saying somehow it's going to contribute to the bottom line. Now, I think often it does, but I think we lose something when we give our corporate managers the sense that that's the only time when they can use corporate assets for philanthropic causes. That's not what the law says. The law has got this enormous vacuum. And I don't think it's what investors would demand once you raise their awareness of the consequences of the corporation's activities. All right, so I saw, yes?
What happens to loyalty in terms of corporations and their shareholders? If there's more than one beneficiary, how does it blur that line? And how do you compensate many beneficiaries?
Right, okay. This is, I'm just clarify the last part. I think I understood the first part.
How do you compensate more than one? So if you're, like with the new CSR model.
Okay, yeah. So, and this is actually, that's a great question, because one of the things that I ask myself, and I would look for your help as communication specialists, is why does shareholder primacy have such incredible sticking power? Why do people find it so appealing? I'll tell you one reason why some people find it appealing. The argument is that, quote, no man can serve two masters. And this is famously associated with Michael Jensen, who was part of the Jensen and Meckling team. And what Michael Jensen actually wrote in a paper, I couldn't believe he wrote this. He said, no organization is capable of maximizing more than one metric at a time. And for an organization to be rational, to be capable of rational purpose, you have to focus on one thing that you're going to maximize. And I was at a conference and Michael made a sort of verbal argument of this sort, that you can't act unless you have only one objective, because it's impossible to balance between two objectives. And I put my hand up and I said, Mike, it's obvious you're not a woman. Because let me tell you, we women, we balance competing objectives all the time. The room cracked up and Michael did not look happy, but the point was made. The reality is, if you actually look, okay, this is the example I like to use. Say you go to lunch. Do you have one objective? Think about it. If your objective is to maximize calories, you're still eating lunch. If your objective was to minimize calories, you never ate lunch at all. If your objective was to maximize pleasure, you only ate dessert. If your objective was to maximize nutrition, you only ate the salad. It's not normal for any organism to maximize one objective. Instead, I think the most sensible way to look at what organisms do is what Herbert Simon, another famous economist, who I think won the Nobel Prize. Did Simon get? Yeah, he calls it satisficing. And he says, look, you've got many different objectives, and what you try and do is reach a satisfactory level for all of them. So this notion that we would expect corporations, which are made up of agglomerations of resources and contracts with millions of different people in different positions, the idea that an institution that complicated should have one objective, that seems to me to be irrational, frankly. But that does not solve your problem. So where did this idea that we have to have one objective come from? I think it comes from a fundamental distrust of directors. And the fear is that if you can't hold their feet to the fire and measure performance by one thing, they're going to run amok and do a terrible job. And this is a very counterintuitive argument I'm about to make, but it's got two parts. The first thing is, we do know that directors can't run amok because the law does have one requirement. Remember, the directors can't steal. It's called the duty of loyalty. The one thing corporate law is really good at doing is making sure that the directors can't steal money. And by the way, how did the executives steal money? Well, they did it because the directors tied pay to performance. The directors didn't want to do that, but the law made them. And then the executives figured out how to turn that into a $100 million pay package. But the law is really good at keeping directors from stealing money. So if they can't steal money, my working hypothesis is, as long as they want to keep their jobs, they're going to want the corporation to survive. And to keep the corporation surviving, they're going to have to keep it profitable, and they're going to have to make sure that everybody who participates in it gets treated sufficiently decently, whether they're employees, customers, investors, that the corporation will go on into the future. And so you have to give up the notion that we're ever going to get optimal performance out of boards of directors. We're never going to get optimal performance, but we might get satisficing performance. And that might actually be better than trying to create one metric when that one metric is so damaging that we're seeing what we're seeing today, which is that corporations aren't performing well for any of their stakeholders, with the possible exception of senior management. And even then, they may walk off with a lot of money, but they lose their jobs after 5 years. Okay, So anyway, great questions. Keep them coming, please. Yeah.
I want to come back to the single metric and
Yeah.
stock price rules. And
Yeah.
do you think that there's any potential for the indices, the reputation studies, like the Dow Jones Sustainability Index, to put pressure on companies to measure across a broad array of stakeholder interests?
I think they face a tremendous problem, and the problem is structural. Okay, so to understand the nature of the problem, okay, first of all, a little background. A lot of corporate executives are aware of this problem. I can't tell you how many people who work for corporations have told me, I see this every day. I constantly see the firm doing things that are not in the long-term interests of the company, even if you measure those interests by profits, but are designed to keep the share price up in the short term. There was actually, I'm trying to remember who did a survey, but one of the consulting firms did a survey of, I think it was 400 chief financial officers, and asked them the following question: would you not do a positive net present value project, one that was going to make profits for the firm? Would you refuse to do that project if you thought it was going to affect your ability to make your earnings targets next quarter? 80% said they would not do the project. 80%. So people in business see this, they see it as a problem. Investors see this as a problem. When I talk to, especially people from the pension fund world, they are constantly insisting, I'm a long-term investor. I represent beneficiaries who are looking to me to fund their retirement. We want long-term returns. Here is the problem, though. Right now, we have made stock trading so cheap that there are lots of people in the market who don't see any cost to buying and selling and flipping their shares very quickly. And what's going to happen is, if there are ways to manipulate the corporation to bump the share price up in the short term, and there are, I mentioned them, big dividend, big repurchase, sell all or part of the firm, cut expenses in the short term. What you're going to do is you're going to get these actors, and they're going to come in and they're going to take positions in the firm, and then they're going to pressure the board to do those things. And what that means is, even if you do have a long-term time frame as an investor, you're never going to be able to realize the benefits of your forward thinking, because you're sharing your company with short-term investors who are going to push for the company to bump up share price, even if it harms you in the long term. So we have what I call an investing tragedy of the commons. Just as if you have a commons, say, a common ocean, and you're fishing in it, you may recognize that if people go out and use seine nets and trawl with seine nets on the bottom, that they're basically sucking up all the sea life. The ability of the sea to generate fish is declining. You're basically going to kill off all the fish in your ocean if you all keep overfishing. Yet no individual fisherman is going to say, well, I'm going to stop fishing so heavily because I want to preserve the oceans. Because he knows that if he restrains himself, the next fisherman, she's going to be out there with the trawler and the seine net, and she's going to be scraping up everything that looks like a life form for miles and miles and miles. And you're still going to end up with an empty, lifeless ocean, except you will have gotten less fish. Well, it's the same dynamic that we're seeing in our stock markets, which is, like if you are a pension fund and you invest in a company and you think it's got a great long-term future, and Carl Icahn or some other activist hedge fund comes along, takes a 10% position and says, I'm going to push the managers to cut expenses and raise the share price. You're going to say to yourself, well, I might as well go along with it because I can make a little extra money along with Carl Icahn on this deal. And then when I turn around, I'll just go take the money and I'll go invest it in another company. And the problem is, when all of the investors are doing that, there are fewer and fewer other companies to invest in. And that's why we're seeing our public companies disappearing. I mean, literally, they're blowing up. And look at Kodak. What a tragedy. Just sold off its patents. There was a wonderful story in Business Week on Procter & Gamble. Procter & Gamble is losing its edge because it no longer does the sort of fundamental research and development that it used to do to generate new products. The financial industry blew up. Half of the banks blew up. The only reason why we don't know they blew up is because they got merged into the other half. But they basically blew up. So what we're seeing is a tragedy of the commons among investors, and it's happening because there will always be someone who's willing to take advantage of that opportunity to make a short-term profit and then get out and hope to go on to the next investment opportunity. And when we all do that, what we're doing is we're collectively shrinking the investment opportunities that we've got. It's one of the reasons why institutional investors like pension funds and mutual funds even are desperate to find something to invest in other than public equities. If you are familiar with the investment world, you know that like foundations and pension funds all want to get into alternative investments, real estate, derivatives, private companies, anything, because there just aren't enough good public companies left where they see the opportunity for the kinds of returns that we used to routinely get from our public corporation sector. All right. A few other hands I saw.
What you're trying to say is that 3% influences all the 97%, and with the market trend and the distrust, so how will like a mass media awareness campaign, I mean, how is it going to attract the 97% who are already being influenced by the 3%?
No, it would help, but you're right. We can't just do that. So this is I've got a 3-point plan. 2 less than Mitt Romney, okay? Okay, 1, we have got to get rid of that stupid law that says you have to tie pay to performance. I think that time has shown that this is one of the most disastrous mass experiments in human motivation we've ever experienced. Just get out of it. I'm going to sound like someone from Cato. Get the government out of telling corporations how to compensate their executives. You know, frankly, they did a better job before. The CEO got $1 million in a jet, and it was like way cheaper and way safer than trying to compensate him or her with stock options. So get rid of that stupid law. But part number 2 is make it harder to be a short-term investor. So what I would like to do, I would like to see us change the capital gains rules so that you have to hold shares for at least 3 years. Preferably 5. And any profit you make on a sale in less than 5 years is treated as ordinary income. And I want this to be true for mutual funds and pension funds too. Right now they get to trade as much as they want and there's no tax consequences. So I want to fix those capital gains rules so that we have more encouragement to invest long term. And then we get our third leg of the stool, and that is a media campaign so that effectively, I'm trying to take that 3%, the short-termers, I'm trying to take them out of the market through the tax code. I'm trying to take away the incentives of CEOs to cater to them by fixing the executive compensation. And then I want to appeal to the angels of our better nature by helping to shift the social context that people see when they make investment decisions. And I believe that if we do all those 3 things, we'll actually, all of us collectively, end up much better off than we are today, which is why it's so easy for me to get enthusiastic about it. Okay, so there's someone who hasn't. Yeah.
So I guess a 4th point on that plan.
Yeah.
For me,
yep.
Would be to also kind of create a little more transparency. I know Professor Bizek had mentioned like the Dow Jones Sustainability Index as well. I mean, 11% of the North American Sustainability Index is plan. And if financials pretty much blew up the whole economy 5 years ago.
Yeah.
So I wouldn't consider that responsible investing. Investing in companies that are.
I'm gonna cheat and fit your 4th point into my 3rd point the following way, because part of the social context that encourages psychopathic investing is the fact that we only get information about financial performance. So you don't know when you're trying to decide how to vote your proxies for BP, the only information you get is financial performance. And if you'd gotten information about some of the other stuff, at least, like before you read about it in the front story of the New York Times, you might make different decisions. So I agree with you. Part of changing the social context to encourage people to be conscientious in investing is providing them with that sort of information. So a popular idea in some business classes is what's called the triple bottom line, where firms not only report information on financial performance, but they also report information on things like employee turnover, and they try it on carbon footprint. The idea is if you can provide investors with information about non-economic factors, they will of course be more likely and more able to take those non-economic factors into account in making their decisions.
But investors have to ask for that.
Well, right now, and that's the irony. Again, you know, I'm actually in favor of regulation in a lot of areas. I keep coming back and blaming the government, but the government was in part responsible for this because when we passed the securities laws, there's only one kind of information that we require corporations to disclose. We require them to disclose the financial information. We don't require them to disclose some of this other stuff. And so that's something worth thinking about. How can we balance out the mix of information that investors get? Yeah.
But aren't the economic and the political imperatives tied together? In as much as like the economic theories of the gentleman from Rochester that you spoke of,
Yeah.
are a nice, shall we say, camouflage, like it provides a nice cover,
Yeah.
I say, for like those who like want to benefit, financially from, say,
Yeah.
putting money into the political system to get policy that allow them to make more profit down the road. So like,
Yeah.
how can you separate, the financial incentive and the political power of those with that financial
Yeah.
incentive of the
Yeah.
status quo?
Yeah.
If you do that, how can you get any of these things implemented?
Yeah. Well, I think you're absolutely right that we have to, if we want to fix this problem, and my own view is it's eminently fixable. We have our 3.5 point plan. It's eminently fixable, but we have to be realistic about the political situation, which means we have to take into account interest groups. And I talk about that a little bit in the book. And what I say, one of the reasons why shareholder primacy rose to the position that it enjoys today is because it had the support of certain influential interest groups. But let's look at those interest groups. Okay. One of the interest groups was academics. They were actually the first interest group. Now, why was it in their interest? One thing, it does allow you to reduce corporations, which are incredibly complex organizations, to something simple that you can explain to a classroom full of students in 5 minutes. Believe me, this really appeals to professors. This is like way easier than really describing the details of the institution and the various governance roles that all of these groups play and the corporation's a legal person. How much easier to just say, oh, shareholders own the corporation and the purpose of the corporation is to maximize shareholder profits. So the other thing that did, though, was that it suggested that there was an easy way to measure corporate performance, and that was share price. And that just so excited a generation of empirical scholars. Because, empirical scholars always look for the keys under the lamppost, right? And this was a beautiful, bright lamppost, and they went right to it like moths to a flame. So what we have to do is get the academics so they no longer see it as being in their interest to embrace this idea. And I've come up with a motivation: shaming them. And so that's part of what the book is. If you can prove to an academic that their ideas are silly, that can often motivate them to consider a change. And that's really my strategy. I'm being really crude about it. But when I get challenged by academics, I look at them and I say, OK, so what part did I get wrong? And if they don't have an answer to that question, that usually triggers the shame motivation. They begin to rethink. Now, another group was business journalists. And they loved this story, not only because it was simple, but also because it gave them a clear villain. Anytime anything went wrong in a corporation, who was to blame? You had a human villain, and the villain was the CEO or the management. Now, I'm suggesting the villain may be actually shareholders, or at least to some extent. That's a much less appealing story. So how do we get the journalists to switch? Well, they're pretty good with the shame motivation, too. So I've actually had, and I must say, I have actually found journalists quicker off the mark than professors. Once you explain to them that there is no legal duty to maximize share price, it's a rare journalist that's going to say it just because it's convenient and easy. So they actually have shown, my experience has been a surprising degree of intellectual integrity. Okay, now hedge funds. Hedge funds love shareholder primacy because they're the 3%, right, that are out there blowing up the companies. If you want to find a human being who comes as close as possible to that platonic shareholder who cares only about the share price of one firm tomorrow, that would be a hedge fund manager. And I'm never going to convince them. They hate me. They hate me. They hate my ideas. They yell at me. They have the veins bulging in their forehead as they're yelling at me. But they're not very popular right now anyway, so I don't worry about them too much. So that leaves us with the two big interest groups that are going to be hard to convince. One is the managers. And here I see a really interesting case of cognitive dissonance. My experience with CEOs is that most of them are actually pretty decent people who really want to build great companies that deliver great products and take care of their employees. I mean, you're allowed to be cynical, but I've met a lot of CEOs, and they may be weird, but they are not the sort of Gordon Gekko caricature that you see in the movies. But at the same time, they're not indifferent to wealth. And they recognize that shareholder primacy ideology has allowed them to get these pay packages that are tied to share price performance that can leave them very wealthy. So that a typical CEO is often like that guy in the old movies where you have the devil on one side and the angel on the other. I want to build a great company, I want to be filthy rich. I want to build a great company, I want to be filthy rich. I think we can get the CEOs if we can move away from the pay for performance. So that leaves the last great interest group, which is the majority of investors who are indeed investing for the long term. And I'm going to be talking to them in about 3 months when I go speak to the Council on Institutional Investors. So if you can help me craft this story so they can hear it, because in fact it is in their self-interest to adopt my 3.5-point plan. They will in fact get better long-term results. But to get there, they have to start by acknowledging that what they've been doing for the last 20 years has not been working well. So there's my interest group theory. All right. Yeah.
Globalization, is this...
Oh, you had to. You had to. Oh, yes. Okay, so... Yeah, no. So this is the big...
Talking to people in China.
Yeah, no, this is the... Oh, you mean globalization in the story?
No, globalization...
Yeah.
There'll always be a cheaper place to have...
Right, okay, yeah. No, this is the big monster in the room. I think that one of the reasons why managerialism worked relatively well in terms of corporations truly taking care of their stakeholders and being relatively socially responsible was that at that time, American corporations had most of their shareholders in America, most of their employees in America, their executives lived in America, and the people who bought their products lived in America, by which I mean the United States. My apologies to any Mexicans or Canadians in the room. I'm sorry, I just did that. Okay. Truly global corporations may be a real problem. I've agreed to write an article on this, but I haven't even begun to think it out yet. Because what happens if you have a corporation where its shareholders are in Qatar and Bahrain, its employees are in the United States, it sells its consumer goods to China, and its executives live in London or some really nice locale.
The 9-year-old in India who's doing some weaving for them.
Right. What you're going to get is a company that might indeed come very close to this psychopathic rationale. Because what I tried to point out was that for most shareholders, their interests should be long-term, they should take account of external costs, they should be non-sociopathic. The minute you get global, the long-term consequences are visited on somebody else, the external costs are visited on someone else, and your conscience is not as pricked when it's someone who is very distant from you, and perhaps you think of them as not an in-group member at all because they're not a citizen of the same. So that's the big, I'm really worried about that. I don't want to be a Pangloss here. I think we can make things better, but that is the problem to keep an eye on. Yeah, you're dead right about that. Yeah, Alice.
I'm thinking a little bit about what you said earlier on. You can only kind of serve one master.
Yeah. Well, I'm saying you can serve more than one, but go ahead.
Or this, you're the counterpart was saying that. And we're also in a room, I think, of probably friendly, friendly folks who believe in this, or hoping to believe that the world can be a better place in this part. So I'm thinking if you're going into a hostile environment with those who are typically not going to believe this, I'm wondering if instead of thinking about it as share price and then reporting on social causes, is there a way to package in from a share price perspective the total cost of doing business, So putting in environmental costs,
Mm-hmm.
putting in employee costs,
Mm-hmm.
and instead of saying, oh, we'll use these metrics as a number of employees or
Mm-hmm.
how green you are, can you actually value those and put it into your share price so it becomes one single number in which you can still focus on? It's just a different value than what currently the definition of share
Yeah.
price is.
Yeah, I mean, I don't think it will ever be reflected in share price per se, but I think what you're suggesting is, can we come up with a single metric that measures all these things? And yeah, there are people who are working on that. I mean, it will never be perfect, because how do you come up with a common metric for employee turnover going from 12 months to 3 years? I mean, how honestly, there are people who will find a way to put a value on that, but it's not easy. But I certainly think that's a good direction to go into. I have very little patience for such projects because, as you can tell, I believe that it's the human condition to have to satisfy different and competing and non-comparable objectives. I think that's reality, this sort of dream of a single metric. I'm a huge believer in evolution and biology. And so I think actually one of the best way to understand the way markets work is to look at them in evolutionary terms. And if you were to compare a corporation to an organism, you would never expect, organisms don't optimize. If you were optimizing, you'd have one kidney. What on earth is the point of dragging around that second kidney? And the reason is you're trying to accomplish two goals. You want efficient organs, but you also want a little duplication to reduce your risk. So organisms satisfy, and you want to stay alive, but you also want to reproduce. So sometimes if you're a male, you'll do really stupid things to impress women, right? You'll go bungee jumping, or you'll go up in a balloon to 40,000 feet and jump out. So organisms don't. I just have a hard time getting my head around this, to me, psychological desire to come up with a single metric. So that goes back to our dinner conversation a little bit about where that psychological desire might come from. But recognizing that some people do have that psychological desire, if you can come up with a single metric that incorporates, the broader it gets, the better the results we're going to get. But I hope I've persuaded you to think about the possibility that maybe satisficing many competing objectives might be something worth thinking about. Yeah. Oh, I'm sorry. I'm losing track. I'm trying to make sure everybody. Have you had a chance to ask a question? Yeah, you did. Oh, well, you and then you. Yeah, I'm sorry. Go ahead.
So I'm wondering what your view is of B corporations and whether they offer a potential solution both to the tragedy of the commons and globalization in the sense that they actually give them an explicit charge.
Yeah, I have a love-hate relationship with B corporations. This is what they do that's good. Some B corporation statutes, and you're going to like this, Mike, require the B corporation to report on non-financial performance. So they overcome that natural bias that the SEC rules create toward focusing only on economic performance. That part of B corporations I like, and if someone wants to opt into it, why not? Why on earth would you ever stop them? This is the part of B corporations that I don't like. In order to sell this idea, and in order to sell the metrics that they were inventing, the people who came up with the B corporation idea went out and told the world that C corporations had a legal duty to maximize share price. And that is not true. So, and you can tell them I said so. They created a problem that didn't exist. I mean, they claimed that B corporations were valuable because they were the only corporate form that allowed you to focus on something other than shareholder value. That was not true. And in the process, they made the problem with C corporations worse by creating a false impression that a C corporation could not take account of other objectives. So mixed views on the B corporation.
Can I counter that slightly? Because I don't think it's that.
You're not one of the people who invented them, are you?
I'm not.
Okay, good.
I studied them a bit.
Okay, yeah.
But I think the difference is that it's not that they give them the option, it's that they explicitly charge the director to do it. Whereas in the C's, they have the option to take the route that most are taking.
So this is so this will be really interesting. And here the statutes vary from state to state. So I think what you're talking about is a relatively small number of B corporation statutes that say the directors have to consider these other interests, and if they don't, they can be sued. And that's an experiment. Let me tell you, I wouldn't touch that one with a 10-foot pole. I'm a real believer in the business judgment rule. I'm a real believer in not inviting people to sue directors for anything other than theft. Because the fact is, what you're going to get is a whole, I mean, what is the standard going to be? Everybody can sue. The consumers can sue. The employees can sue. What you're going to get possibly is just a bunch of lawsuits. Maybe I'm too cynical. So that'll be interesting to see how that turns out. But a lot of but some B corporation statutes don't create that right to sue. So
I wasn't thinking of the right to sue. I was simply thinking of the right to embed it in the charter the notion that the corporation is there to do more than
you can do that now.
You can, but you don't have to.
Oh, no. Okay. Yeah, but, okay. All right. So I'm being a real lawyer here. My view is if you can't sue to enforce it, it's irrelevant. So, but let me talk about corporate charters, by the way. This is another interesting example. If shareholder primacy were all that great, the business world could have come up with this on its own, bottom up. Why? Because under the state corporate codes, Delaware, for example, requires you to describe the corporation's purpose in your charter, and but gives you free rein to put what the purpose of the corporation is. If you look at the charters of modern corporations, you know what they all say? The purpose is to do anything lawful. There's no reason why you couldn't put the purpose of this corporation is to maximize shareholder price. But no one ever does, which to me is evidence that from a bottom-up perspective, the business world does not think this is a great idea. But I will also direct you to some interesting historical evidence. In the early part of the 20th century, it was much more common for companies to describe their corporate purpose in greater detail, and I found a few of those. Our purpose is to produce paints and chemicals. Our purpose is to produce oil. Our purpose is to do this, that, and the other. You know what they all have in common? To the extent they describe purpose, it doesn't revolve around employees, investors. It revolves around the products. So, you know, I know there are some people like, I think, like Stephen Denning at Forbes, who is a big, he calls it product primacy, not shareholder primacy, but product primacy. Even though Stephen and I disagree on some things, he would love it if I were to tell him this charter story. So anyway, you know, so obviously I don't actually think, whatever's in your charter, if it isn't backed up with the ability for someone to sue, I don't attach that much importance to it. But to the extent it has an aspirational value, you know, you can do that with a C corporation. Yeah. Great. Oh, I'm sorry, yeah. Do you want to follow?
So I had a follow-up on the previous subject.
Yeah, yeah.
Talked about satisficing.
Yes.
And I believe in one of the articles you wrote, it said something like in the last 20 years, equity-based executive compensation has gone from like 0 to 60% of the entire compensation.
Actually, 80.
80.
Or yeah.
So, so obviously, they're certainly incentivized to maximize that number.
Right.
I only bring that up because I wonder if there's a way to satisfy the different values that a executive is supposed to be a steward of the company and of, you know, broader-based stakeholders. If there's a way to maybe not have one composite number, but maybe several different numbers, which each is based in different compensations for the executive.
Yeah. No, and people are talking about that, and this might make Alice happy, because this is sort of another way of getting to where you want to go, which is we say you're going to have chunks of your compensation based on your performance along many different measures. And that would certainly be an enormous help. I would love to see that. And I would think, and at the end of the day, it does come down to one measure. The measure is dollars, right? But you could tie the dollar amounts to, you know, if you can get employee turnover down, you make more money. If you can get consumer satisfaction survey numbers up, you can make more money. You know, if you can get your carbon footprint down, you know, at some point you're still going to be inviting people to manipulate these numbers, but at least it becomes less easy to manipulate than if you have one number like share price. Yeah, so I mean, those are all, and by the way, and those are things that we can do already. And what is missing mostly is the ability to insulate the directors from pressure from short-term shareholders, which we could fix with changing the capital gains rules, and just getting them to normatively buy into the idea that that's appropriate. So, you know, that's doable too. Yeah.
So what's your thought on the myth of the commons, the myth of the community, the myth of a sense of togetherness that kind of arouses, having singular measures that arouses questions of, we live somewhere, why aren't we responsible for our actions? I mean, that itself seems to me to be a particular myth in the context of globalization, where my sense of space is really irrelevant. I mean, you could think about the change in architecture that's occurred through time. The front porch no longer exists as a place where if you're affluent, that you're going to be. You're going to be in the back porch, and you're going to drive into a garage, and you can have basically a minefield around your home, right?
Yeah.
To protect you.
Yeah.
So what's your sense of the sort of the hanging on to notions of community? I mean, it might be like, Robert Reich made this argument in terms of the idea of the nation and
right.
We're all in this together.
Yeah. I think I understand your question, and I talk about this in length at excessive length in my first book, and that's the Cultivating Conscience book. And it goes back to this Jekyll-Hyde syndrome that we see. In some contexts, we feel as if we have an obligation to other people. In other contexts, we feel, let them all go hang. It's not my responsibility, not my problem, not my job. I didn't mean, and I thought I was very careful in that book to say, I'm not saying that selfishness is always bad. Selfishness can be great. If I have appendicitis, and the best way to get a surgeon out in the middle of the night is to appeal to her selfishness, I think selfishness is fabulous. And this is part of the story of Adam Smith. He talks about the classic transaction between the butcher and the baker, where in the pursuit of only self-interest, they do a transaction that leaves them both better off, and that's great. But we know that there are situations where selfishness does not produce optimal results, and the tragedy of the commons is one of them. And so I actually view, in this book I argue that one of the fundamental tasks of law is to try and channel human behavior in a way that produces the most peace and prosperity on a large scale. Sometimes that is best done by encouraging people to be selfish. Sometimes it's best done by encouraging people to be pro-social. And I would say when it comes to investing, it's going to be a mix of both. I think we can actually get very good results by saying, we want you to focus your investing decisions so that you're putting your money into the enterprise that is as productive as possible without externalizing costs or violating the law. And I think that might work pretty well. So you see, that's a sort of mix. And that's actually a fairly typical mode of human behavior. When you go to a wedding reception, you feel like you need to bring a gift. But you don't feel like you need to take out a second mortgage on your house to pay for the gift. It's a token gift. So it's very easy to encourage normal human beings who are not sociopathic to take some limited account of ethical rules and others' interests. And I think that's all we need to do in investing to get results that are much better than the results that we're getting from a purely psychopathic, you should invest your money to get the highest possible return without any concern whatsoever for how that return is being generated. Is that helpful? Okay. Yeah.
Throughout your presentation, this saying kept coming back to me, the idea that if you can measure it, you can manage it.
Yeah.
And so help me out with this. In part, I hear in your presentation saying that that's absolutely the problem.
Mm-hmm.
But I also hear in your presentation saying that's the solution. So, but I don't know if that's exactly what you're saying.
Actually, what I'd say is the problem with if you can measure it, you can management is that the implicit subtext is that if you can't measure it, you can't manage it. I think that's dead wrong. I think people make decisions all the time when formal metrics are not available. And the proof is in the pudding. Some of them work out better, some of them work out worse. But people are we're forced to make decisions, in part because we live in a world of uncertainty, which is a statistical concept. It means we don't know the probabilities of future events. We have to make decisions without having complete measurement. That said, when you can measure, there is some value in measuring. And if we're going to measure, at least we ought to try and measure across all of the relevant measurable phenomena that we can. So I hope that straightened it out a little bit.
Because some of your solutions actually don't talk about measuring, they talk about building foundations for relationships.
Yeah, and I actually, right, and I actually think we got much better results in executive compensation when we were doing it on that basis. There was there was very little attempt to come up with a formal metric for what an executive added to the firm. Directors did it by a seat of the pants strategy, and they actually got better results. Executives produced better results. There were fewer scandals. You know, investors got better returns. There was greater equality between the level of the CEO's pay and the level of the average employee's pay. And you didn't get firms loading on huge amounts of risk so that the director could try and benefit from the stock options.
And this is one of the problems with the transparency movement.
Oh, that it demands that you measure?
I mean, to excess.
Yeah.
And it erodes the fundamental
idea
about the relationship.
Well, I mean,
you keep measuring everything.
Right.
At some point, you start undermining the nature of the relationship.
No. So I think it's very situationally specific when you want to measure and when you won't. So I don't want to make a broad statement, but I will say, and this is really interesting, there's lots of data that every time a nation state shifts from not reporting CEO pay to publicly reporting CEO pay, what we find is that executive pay jumps after it becomes publicly disclosed. Yep, it gets much higher. And I think that's, I mean, you know, people disagree on what the mechanism is, but the argument that I have found most persuasive is the minute it's publicly disclosed, all the CEOs start comparing their pay to everybody else's pay, and it's like woebegone. They all have to be above average. So, but that is an example, actually, you're exactly right, of we might have actually gotten better results with CEO pay when we had less transparency. Yeah. Well, actually, factually, we did. Now, you can argue, I mean, the correlation's clear. Causation, you can argue about. Yeah. Right.
One last question.
All right, yeah.
So where do we start? Like, where do we move the giants?
Okay, okay, one thing you can do, there actually are real live brave Congress people who are trying to get a stock transaction tax. One of them is Peter DeFries, I think in Washington, and the other one is one of my favorite, Tom Harkin of Iowa, just one of the great, reasonable, I mean, in my view, reasonable politicians. He was one of the ones who helped Blanche Lincoln get the Volcker Rule put in Dodd-Frank when they passed it. So, to me, and there's actually a lot of groups that are working on this, trying to amend the tax code so that short-term trading is, I mean, this is ridiculous. If you buy toothpaste, you pay a sales tax. If you buy a car, you pay a sales tax. If you buy a hip replacement joint, you pay a sales tax. If you buy and sell stocks, you don't pay a sales tax. We had one, we got rid of it. Now, there are reasons why it might be easier just to amend the capital gains rules and more effective. But what I find amazing is how successful trading interests have been in an interest group in basically manipulating the regulatory scheme to their advantage so that we tax hip replacement joints, but not stock sales. So that's one place to start. The next place to start is go to your professors if they're still teaching shareholder primacy and use shame. And say, are you aware of this other approach that's been covered by the New York Times? Are you up on this? So that's a good way. I mean, seriously, and the change has got to come, I hate to say it, but it's got to come from students demanding more of their instructors. Because I'll tell you from a professor's perspective, once I've prepared a class, the last thing I ever want to do is do more work and, and change what I'm teaching. So you need to motivate professors to do the extra work of exploring some alternative ideas in their classes. And for CEO pay, I don't know, I don't hear anyone talking about repealing that part of the tax code. Boy, I wish they would. So. All right.
Okay,
So.
I have a small token of appreciation.
Oh, I get a token. Yay.
It's funny because this is a replica of the gift bag given to the shareholders attending the Johnson & Johnson shareholder meeting. It's only appropriate.
That's great. That's great.
Join me in thanking.
Thank you. Oh, this is hilarious.